What's up, everyone? Welcome to another episode of The Remote Real Estate Investor. I'm Michael Albaum, and today I'm joined by
Emil Shore.
And today, Emil and I are going to be talking about some of the hot vocab words you may have heard about as a real estate investor. We like to sound fancier and smarter than we are, so we use silly, fancy words for kind of some everyday things. So we're going to be dissecting those and talking through what they mean and how to use them. So let's get into it. All right, Emil. There's like all kinds of fancy words thrown around. People love talking very highbrow as real estate investors, very pinky out, if you will. So let's dive into a couple of these. And I'm wondering if we can start with cap rate, since I think it's a very common term that a lot of folks may be familiar with. Some of our newer listeners might not be. So can you give us a definition of what a cap rate is and how you actually use it when determining whether or not an investment makes sense for you?
Yes, sir. So I'm on Roofstock site, and luckily there's a bunch of, these are calculated on every property listed on the site, and you get a nice little eye icon next to each one of these that explain what each term means. So I'm just going to read it from the Roofstock site, and then we'll dive into it a little bit more. So the cap rate is the percentage return calculated by dividing net operating income in year one by the property purchase price. Your net operating cash flow excludes your loan costs. So cap rate is basically all of your income minus all of your expenses, except for the cost of the loan. So this assumes you're paying all cash. It's useful in comparing properties, apples to apples, right? We'll get into cash on cash in a minute, but cap rate can be more useful in analyzing properties without the use of leverage to compare them more easily to see what kind of return you get.
Yeah.
Because oftentimes with a loan, with financing, you can juice returns, but cap rate, again, just allows you to do more apples to apples.
Perfect. And another way that I've kind of taught cap rate and what it is inside the Roofstock Academy is basically it's your cash on cash return for an all cash purchase. So if you see a property that's listed for $100,000 advertised at a 5% cap rate, you would expect a 5% return on your $100,000 purchase, i.e. a $5,000 NOI, or put $5,000 in your pocket. Now, just like you mentioned, as soon as you put leverage on it, things can change. And so if you and I both bought a 5 cap property for $100,000 and you used 80% leverage and I used 60% leverage, we would have different cash on cash returns. But from a performance standpoint, we would expect the same cap rate.
Very well said. I think I'm just going to take a backseat on this episode. You are doing a much better job of explaining things. So see you later, Michael.
Hey, it's been a lot of fun, Emil. Take care.
Bye.
No, so when using cap rates, I mean, how do you think about it when determining whether or not an investment makes sense for you?
I am a very simple man. I basically
simple pleasures.
I basically look at cash flow and cash on cash when I am making investment decisions. But again, the cap rate is useful in comparing properties without the use of leverage to potentially juice your returns. So it is a very common metric that investors use. I just don't use it that much. I'm more of a cash, like what is my actual cash flow and what is my cash on cash?
Yeah, makes total sense. I think cap rate is, I use it for kind of like surveying the market and seeing, okay, this type of property is selling for an 8 cap all across town. So why is this particular property listed at a 7 cap or a 6 cap or a 10 cap, right? Why is this property, what is it? One of these things is not like the others. So using it as kind of a benchmarking tool and determining what is appropriate for the market, because that's also what a cap rate can tell us. So that's something else that a cap rate can tell us. So that's how I've used them in the past, just to get a flavor for a market.
Yep. I mean, if you assume the same like down payment and financing percentage, you can do the same thing with your cash on cash, right? Like here's what this market produces in terms of cash on cash if I assume 20% down on every property I look at.
Sort of, but I think cap rate is a better indicator because it's a better equalizer because it's basically an indication of what kind of return someone is willing to accept for that given property. So for the risk and
right.
I mean, price aside, right? Because 8% is 8%.
Yeah.
So for the quality and location of this property, someone is demanding a 6% return versus a much higher end property in a much better part of town. Someone should be willing to accept a lesser return. And then, of course, go the opposite with the opposite. So I think when you put leverage and cash flow, it introduces kind of this second or third variable that makes it a little bit more confusing. So if you just look at cap rate, it's kind of a nice way to say, okay, well, this is the return I would expect. Now I put leverage on it. I should hopefully get a better return. If not, it might not be a great candidate for leverage.
That's a good way to explain it.
Sweet. All right, so let's transition here to a metric that you mentioned you use a lot, cash on cash return. What is it and how do you use it, Mr. Eyebrows?
So again, I'm gonna read it directly, the definition, and then we'll get into it a little bit more. So cash on cash is a measure of return on your initial investment after your first full year of ownership. It is equal to your net cash flow after all expenses and loan payments divided by your initial investment amount. So that basically this looks at, okay, let's say I make, after paying all my expenses, loan, property tax, vacancy, every single thing, I end up with $1,200 at the end of the year, right? If I put in $20,000 as my down payment, plus closing costs, plus all those things, the way I'd find my cash on cash is I would divide that $1,200 by my initial investment of $20,000 to find my cash on cash return, which my brain is a little slow, but what is that? I'm going to use my calculator on my sheet. I think you're right, but I didn't want to say it and sound stupid. 6% it is. There you go. So that would be a 6% cash on cash return. So it's basically looking at, of the money I put in, how much am I actually profiting?
Right.
What percentage?
All right. So here's a question for you. Your pro forma says you should end up with $1,200 a year because of your vacancy, your CapEx, your repair maintenance, but you had maybe a really good year and you didn't have vacancy and you didn't have a leasing fee and you didn't have as much CapEx as you anticipated. So you end up with actually $2,000.
Okay.
Are you touting to the world, hey, I made a 10% cash on cash return? Or are you earmarking those dollars and like setting them aside and saying, I've already quote unquote spent them because if it's not today, it'll be next year?
What I actually do is, I've talked about this on a prior episode, all the profit, all the cash flow we receive goes into a separate real estate checking account, which I don't touch. It's only used for reinvestment or paying for CapEx or whatever, reserves, all that stuff. So we don't touch our cash flow now. So it's all sitting there. We're going to assume if we have a good year, we're waiting for something to happen. Like I never assume that, it's going to be like this every single year. I think the longer you do this, you realize things break all the time. It's part of the business. You're going to have capital expenses, even if you have, 5 years without it. You're going to have a vacancy. You're going to have all these things. And once you go through them, you know that real estate investing requires money and you need to have reserves. So we don't touch any of that stuff. It just sits in its own account.
Okay. So from when you look at your historic performance, you would say, again, even if you ended up with $2,000, you would say that you actually profited $1,200.
No. So at the end of every year, we actually look at like our actual performance, but I just sum it up, right? Yes, great. I did great year one, but what I'm looking at more so is like, I'm adding all those up. Let's say my first property I bought in 2017. So like the last 4 years, how have we actually performed?
Got it. So you're looking at it over time, not just isolated year by year.
Right. I mean, I have this spreadsheet where we do look at it on a year by year basis, but also summed up together. And that's more so what I care about.
Sweet. All right. And are you including your closing costs, the cost of the loan and the cost of the title and the escrow in your cash on cash return calculation?
I am. The only thing I don't include is, so a lot of times if you impound your property tax and your insurance, like when you close on a property, you're going to pay like the first year of that. So it looks like those are additional closing costs. I separate those out and those are just insurance and property tax line items, right? So I avoid double counting those things because it can be easy to like, you know what I'm talking about? Like it looks like it's closing costs, but it's just you're prepaying for those things. Right. So I exclude those.
Yeah, it makes total sense. All right, cool.
Yeah.
Nicely done. All right, well, let's move on now to cash flow.
All right.
How do you calculate cash flow on a property? And what is cash flow?
So cash flow is the profit you end up with at the end of the year after paying all your expenses. So you have rental income that comes in, right? That's what your tenant pays you. And then all your expenses, your financing, so that's your mortgage, your property taxes, your insurance, any repairs and maintenance you paid for, right? Vacancy, that's lost revenue, and then turns, if you got to pay to fix it and rent it out. If you have a property manager, paying them their management fees. So it's literally your profit and loss, right? How much did you make at the end of the year? That is your cash flow. And we actually did an episode earlier, which we'll have either in the show notes, or if you're watching on YouTube, there might be like a card you can click on. And basically we talk about how you should actually look at your cash flow, because a lot of times people will say, it's your rental income minus your mortgage and maybe your property tax and insurance. And it's like, no. There's so many other things that go into this, especially as you're looking at, your forecast, your pro forma, what can you expect on a property? There's all these things you need to be including on that. So we cover that at length at that full episode.
So if I'm hearing you right, what you're saying is on my $2,000 a month rental, my mortgage is $500 a month. I'm not cash flowing $1,500 a month?
No. Contrary to what you may see on YouTube and Twitter and some other forums, that is not how cash flow works. You're going to have a lot more expenses than that. Trust me.
But in that month, I ended up with $1,500. So I don't understand.
Oh, you silly man, Michael.
I hear that question, all the time. And what I always explain to people is like, we have to, in the way that we model real estate investments and cash flow specifically, we level everything out. And so we assume every month you'll have $50 repair and maintenance. Every month you pay $100 in property tax. Every month you pay $50 in insurance. And it becomes this nice uniform income and expense calculation. When in reality, I think you coined the term, maybe not coined it, but you said it here first, that it's lumpy. So you might pay property taxes once a year, and that might be your $1,200. And so in that given month, you're going to have you might have a negative cash flow. But to model it out, to make some assumptions, we smooth everything and assume that it's uniform, which is just not the case.
Right.
So I always, like you, go back and kind of earmark those dollars. And yeah, this month I ended up with $1,500, but that's to pay for the property taxes that are going to be due in 6 months from now. And the expenses, the plumber or electrician call out that I'm going to have 2 months from now.
Yeah. And even on a yearly basis, forget monthly for a second, like, again, you could have a great year, and then year two, you have vacancy and you may be negative that year. Like you may have come out of pocket in terms of cash flow for the year, but you want to look at this over a longer time horizon, right? Mm-hmm. That's why in our pro formas, we just, we set a standard rate, even if we don't have it in that month, to just kind of smooth things out.
Love it. All right, man. Let's move on now to IRR.
IRR, annualized return, also known as internal rate of return, is a measure of annualized net return on an equity investment. It equals the discount rate at which the sum of the present value of all cash flows is zero. Calculation is based on actual and budgeted values. So what does that all mean?
Sounds like a lot of Greek to me.
I have no idea. I have never used IRR. I know it's important. I know a lot of finance people talk about it. Again, I'm a very simple man. I have never calculated an IRR for a property I've bought. But Michael, I'm hoping you can shed more light here.
Yeah, totally. It's a very complicated calculation for anyone that's done it by hand. There's a pretty easy way to do it in Excel. There's an IRR function in Excel. And so basically it's a way of calculating future cash flows, oftentimes including a sale, and determining what that looks like over time. Because if you can imagine, like in year one, if you buy a property, you're going to have these cash flows. And then if you sold it at the end of the year, you're going to have a return on your investment. And we can very easily calculate that because it's over the course of 1 year. Well, oftentimes these investments are over a long period of time, multiple years, sometimes decades. And so we want a way to move those cash flows and account for the time value of money in a sense. And so we are totaling all of the cash flows that happen year over year, month over month, whatever frequency you want to calculate your IRR in. And then oftentimes we assume a future sale. And so our dollars have been working for us all of that time. And so this is a way of capturing basically how hard our dollars are working for us over a time that is different than a 1 year period. So that was a very long-winded way of saying it's a time-bound calculation that gives us an idea of what our dollars are doing for us. Like you, it's not something that I use very regularly in terms of determining if something is a good purchase or a bad investment. And that's mostly because for these equations to make a whole lot of sense, I've found, we have to assume a future sale price, which is not something that I'm going to do. And so I'm going to force value. I'm going to add value, hope for appreciation on single family stuff. But I'm more concerned with kind of the day-to-day, year-over-year operation and what the cash flow numbers look like.
Right. I agree. I think if you come into an investment knowing, okay, we want to hold this for 5 years, and here's our appreciation assumption, here's our cash flow assumption, all those things, that's when people start really using IRR because they know their exit timeline. Otherwise, it's like, I don't know, I feel like you're kind of throwing a finger to the wind and saying, we'll see.
Yeah, because it could be like you could make an IRR calculation look amazing based on what your assumed sale price is. So like, I think they often use it in syndications and bigger deals where they're raising capital. And so I would look to get a very clear understanding of like, okay, what's your assumed, like as Tom always said, what's going on in the sausage? How is the sausage being made? What are the assumptions around the annual cash flow? What are the assumptions around the future sale price? What are the assumptions around that the exit cap rate? That's oftentimes what they're looking at. And just get very clear on what that is, because that's going to impact the IRR significantly.
Yeah, I think you're right. Like, this is more common in funds and syndications where investors want to see all the assumptions, when are we going to exit, all those things before they put money in. I less so see, mom and pop, just people investing their own money really leaning on this metric personally from what I've seen.
Yeah. And again, this whole episode goes to highlight that there's no right or wrong way or right or wrong metric to use. Everybody is different. And so figure out what's important for you and then use that. So Emil likes cash flow and cash on cash. Somebody out there might love IRR and cap rate. So great. If that makes sense for you, awesome. Let's talk about gross yield. What is it? How do you use it?
Yeah, so gross yield is the annual income generated by an asset before any expenses divided by its purchase price. So you take monthly rent, multiply by 12 months, and you divide it by the purchase price. So if I buy a property for $100,000 and my rent is $1,000, I would multiply that rent times 12. So 12,000 divided by the purchase price, which would give me
12%.
12%. Like I said, 12%. Man, slow today. So I get 12%. So that's my gross yield. I don't find this to be a particularly helpful metric. You'll see it often. Obviously, it doesn't assume any expenses. It doesn't tell me my property tax, insurance, all those things. It can be misleading in that a high gross yield, like a market like Texas, right, could have a higher gross yield, but we know that property taxes are higher in Texas. So it doesn't factor any of those things. So to me, if you're comparing properties in different markets, it's not super helpful. Maybe if you're comparing properties in the same market, helpful, but I would never use this to compare two different properties in two markets.
Yeah, I think you nailed it. Because it's a very quick and dirty calculation of what's the rent to sale price. Like, this is just another way to say it.
Exactly.
Awesome. All right, Emil, this was a lot of fun, man. Hopefully people can have a better understanding of what these terms mean, how to use them, and then go use them in their everyday investing careers. As always, if you like the episode, feel free to leave us a rating or review. We look forward to seeing you on the next one. Happy investing.
Happy investing.